Hey, it's Barry Page with Legacy Money, and I've got a great video for you today on retirement income. Now, regardless of where you are in life, this video is very educational. I think you're going to learn a lot about how income works, but specifically if you are over the age of 50, you're going to enjoy learning about these secret strategies that are hidden in plain sight that can help you accumulate more and distribute more during retirement. Before I forget, I want to remind you to go ahead and subscribe to our YouTube channel, Legacy Money, and hit the little bell so you'll be notified when I have new videos. All right, let's get into it. So on the board here, you'll see that I have income, which could be considered cash flow. If you are a business type, you might understand that term a little better. And accumulation during our working years and distribution during our retirement years. So typically we start working, earning income, saving at about the age 25. And today, retirement age is somewhere around age 65. So we'll use those numbers just because they're nice and round. And we're going to take somebody on out to age 100. Depending on where you are, if you're over age 50, you're married, your wife is about the same age, or your spouse, you're probably going to live to expected mortality rates about age 90 today. But we're going to give you a few extra years just to keep things simple. So that's what it's really all about, is simplicity, and I want to share all of that with you. So stay with me. My mission is simple: to help you protect your family and keep more of your money. I'm here to help level the playing field for families and those who seek the truth. There's always a new way to make money, but at the end of the day, it's your family's security and your legacy that matter. And I promise to help you protect what's really important to you. Legacy Money starts now. Okay, let's get started. I'm excited to share this MasterClass educational training with you. It's all about retirement income, and specifically, we like to call it passive income. Retirement income, this is the smartest and simplest way to create cash flow and generational wealth ever. Retirement income. I want to share with you the smartest and simplest way to create tax-exempt cash flow and generational wealth ever. I've spoken with advisors all over the country, worked with CPAs, tax attorneys, and by far, this is the strategy that most people can use to create more income. So I want to talk to you about rethinking your retirement. We've been led to believe that the more money we accumulate, the wealthier we'll become. But is it really about accumulating more wealth? Ultimately, we need income to live, and the amount of spendable income we have available is really all that matters. So in this video training, I'm going to provide you with examples, real-life examples that I've used with my clients and myself, where I'll show you how to get distribution rates that are up to 2 to 3 times more than traditional accounts. How you can take withdrawals at any time without penalty. How you can create cash flow that isn't reportable as income to the IRS. And how to create generational wealth that lives on long after you do. Here's what I believe. My mission is to educate and inspire others to take control of their finances so they never have to depend on banks or government plans. I believe in family, freedom, and independence. I believe that most Americans are sick and tired of the lies and the corruption. They're concerned about their financial future and the impact of taxes on their income. Most people have been beaten down and are fearful of seeing their own personal value. So I want to share how to use your economic value to create more and to do more with your money. I believe that most people should be in control of their finances so they can reach their true potential. Sib Kiss, see it big, keep it simple. The older I get, the more that motto sticks with me. Life is complicated enough already, so why make our retirement complicated? I want you to challenge conventional plans, government plans, qualified plans, and bank rules. And I want to teach you how to avoid expenses, wealth managers, accountants, lawyers, trust. In some cases, they may be needed, but for the most part, you can avoid the cost incurred from hiring these expensive advisors. Now, I want to warn you, this is not compliance approved. It's not been approved by any compliance department, so you'll want to consult with your tax advisor. I'm not a tax advisor, and I accept no responsibility for sharing this content. I'm going to share with you a simple and actionable plan that you can use to create tax-free income, whether it be during retirement or prior, depending on your age. I use these same strategies myself, and I use them with my clients. So who is this for? Well, it's for baby boomers primarily, and those concerned about their financial future. I was born the last year of the baby boomers, but pretty much anyone over 50 should be able to benefit greatly because you are ready. You are in the exact time frame that it takes that is most important to prepare for your future. I'm not a big advocate of retirement, but what I am is an advocate of creating passive income that you can outlive, and income that will be there for you whether or not you work or not. So here's some important questions to ask yourself. Do you want to have a similar lifestyle as you have today when you retire? What rate of return do you have to earn on your savings and investment dollars to be able to retire at your current standard of living and have your money last through your life expectancy? How much do you need to save on a monthly or annual basis to be able to retire at your current standard of living and have your money last until life expectancy? And how long will you have to work to be able to retire and live like your current lifestyle again until life expectancy? And have you considered the impact of taxes on your future income? So when I talk to baby boomers, here's the fears that I hear on a constant basis. They're concerned, they fear outliving their savings. They're afraid to lose their money. They have desires. The financial desires include having enough income to live on. It includes safety, protecting themselves and their family and their money. And it includes guarantees. They want to have some type of security guarantee that they will be able to live a safe and comfortable retirement. So I just looked at a study today from Fidelity Investment, and it looked at 50-somethings, the baby boomers that we're talking about, and their average account balance, 401k balance, was $160,000. And most of these people were contributing up to 10% of their income to these accounts. Now, that might be because they've lost money, they fell behind, but that is a comfortable number, and so that's the number that I like to work with. But also, just want you to know that we recommend that you start saving very early and that you save more than 10% of your income. We actually suggest 20% of your income. Now, not everyone can do that, especially in the beginning, but once you learn to control how your money flows, that becomes a lot easier to do. So we're going to work with these numbers, 50-somethings, baby boomers, with an average account balance of $165,000. Retirement ready. Are you ready? These are the numbers, again, that came from Fidelity Investments and what I'm going to use in this example. So if you look here, This is what happens at age 64. They've accumulated $512,677. And they're going to take $90,000 at age 65 for income. So that would leave them with $439,585, right? Now, they would keep taking that $90,000 income, but what I want you to notice is that at age 70, they have ran out of money. Now, they may still have Social Security or some other type of pension or some other type of income, but this is what that retirement account would distribute for them, okay? So the money is gone. What happens then? Examples of some things that you or this person might be able to do. So they were saving $10,000 a year, $833 roughly a month. They could obviously save more during these last 10 years if they were able to, right? They could maybe not retire at age 65. Maybe they wanted to work to age 70. So they could work longer. I'm not sure if that's what you want to do, if that's been your planned retirement age, but that's obviously an option. They could spend less. So instead of the, taking $90,000 a year or $7,500 a month, maybe they could live on less money. They could spend less. Or, maybe inflation would change. Now, we haven't even calculated inflation into this example, so it's not relative in this case. So what could we do? I'm just trying to give you an idea of what retirement may look like, because I find that most people have really never worked these numbers out. Major transfers of our wealth, all of us, okay, they are the largest. And these three transfers are taxes, interest, and fees. They can decimate retirement income. But there's more risk. There's other problems. There's market risk. If your money is in the stock markets, it really doesn't matter if it's even in the stock market. It could be in any market. It could be the real estate market. It could be precious metals. Most assets are subject to risk, losing the money. Then, of course, there's longevity risk. That means you're living longer. Maybe you expected or anticipated your retirement income lasting until your age 80, and you live to age 90, or you live to age 100, okay? Then there's inflation, of course. So that means that our buying power is less, our dollars are worth less, we have less spendable income. So let's look at taxes for a minute. Now, this is the history of taxes since taxes were created in 1913. 57%, that is the average tax bracket, 57.69. That's what taxes have averaged for the highest marginal bracket. And of course, not everybody's in that bracket, but it's all relative. So I'm just trying to show you an example of how taxes fluctuate over time. So the average since they were created, as we know them today anyway, with the IRS, has been about 60%, 57.69. So in this example, if someone had $1 million, okay, the IRS would get $580,000, and we would be left, or this person would be left with $420,000. How does that sound? Now, we don't know what taxes will be when we retire. All we know is what they are today, and we know that in 2026 we will have some tax law changes. Of course, we just had some tax law changes last year, and they are all relative to the current administration. So I'll show you some examples. In 1913 is when the IRS created our current tax system. In 1929, we had the stock market crash. So if you see here, that's where that happened, okay? Now, in 1935, FDR created Social Security. So that's where you see taxes started to go up and rise dramatically. Look at that. Taxes were as high as 94% in the early 40s, okay? And then they stayed around 90% for several years. LBJ created Medicare in 1965, right over here, you can see taxes took a bump up right there. And in 1971, Nixon removed us from the gold standard. So right around here, we came off of the gold standard and taxes spiked up a little bit there as well. ERISA was passed in 74, and in 1980, President Reagan elected the largest tax decreases in history. So that's where taxes reduced dramatically. This is the first Bush. Read my lips, I won't raise taxes. This is Clinton. This is the second Bush. This is Obama, and here we are again today. So today, the highest marginal bracket is 39-40%. Now, you have to make about $600,000 or more to be in that bracket. But again, it's all relative. Most people, somebody earning $100,000 a year, are going to be in a 25 to 30% bracket today. But ask yourself, what will taxes be in the future? So the point of this example is to show you that the tax laws change, right? They change often, basically through every administration. And, if you just look here at what happened in 2017, we had that tax cuts in the Jobs Act. But in 2019, we had $123 trillion of unfunded liabilities. Just this year, 2020, we had the CARES Act passed. And, we've got politicians promising Medicare for all, free college for all. Where will the money come from? There's a cartoon here. It's a new idea where you plunder them just a little on a regular basis. It's called taxation. So here's the numbers today. Now, I just showed you in 2019, just last year, we had about $123 trillion in unfunded liabilities. These are the numbers today. Okay? We've got $25 trillion national debt, and our unfunded liabilities are $147 trillion. Now, this is the number they talk about. Okay? That's about $78,000 per citizen, or $207,000 per taxpayer. But this is what they don't talk about, the Social Security liability. This is the promises that have already been made to people on Social Security. Baby boomers, you and me, Medicare liability for the baby boomers, $31 trillion. If you add that up plus the other debt, we've got over $147 trillion. Where will this money come from? This is David Walker. He said the current fiscal policy is unsustainable. We're heading to a future where we'll have to double federal taxes or cut federal spending by 60%. Now, David Walker wasn't just anyone. He was the former Comptroller General of the United States during Bush and Clinton. Okay? He's an accountant. He knows how numbers work. Now, just looking at his quote here, what do you think's more likely? Doubling federal taxes or cutting federal spending by 60%? Let's get back to retirement. I like to relate it to climbing a mountain. Okay? So pictured here is Mount Everest. If you were looking at Mount Everest, climbing a mountain, what's the goal? Well, most people would say that they want to get to the top, right? Well, it's crowded on the way up, and people pay big money. This is an actual picture from a couple of years ago of people climbing Mount Everest. So you can see that it's very crowded, and people pay big money to get to the top. All right? So we're at the top now, the summit of the mountain. We're looking out. Yahoo, we climb the mountain. Here's an actual picture of me at the top of the world, literally. This is in Whistler Resort in Canada, British Columbia. And that's me on my downhill mountain bike. I like to ride bicycles, mountain bikes specifically, and I like to ride downhill. So accumulation, when we're saving money, is when we're ascending the mountain. Okay? Distribution, retirement, is when we're descending the mountain. So we accumulate money and we distribute the money that we've saved or accumulated over time. So there's obstacles, there's boulders, and there's risk going both ways. The difference is the risks are much higher on the way down. More people actually die coming down Mount Everest than they do going up. So you need a Sherpa. You need a guide to get you through this. And most advisors are not concerned about getting you down the mountain. The talk is always about getting you a higher rate of return. That's not what this is about. What I want to teach you is how to have more spendable income, tax-free. And downhill is fast. You are moving. There's taxes. We don't know what's going to happen. Life is compressed. We have less years to live. There's inflation. There's market risk. There's longevity risk. We could live too long. We could die too soon. But it's coming at us quickly on the way down. So distribution is about descending. And relating retirement distributions to descending a mountain, there's more risk for the retiree. The impact is much greater on the descent because there's less time to correct. On the way up the mountain, we can correct. We can try different things. We can move money around. We can make up for lost time, hopefully. But on the way down, there's less time. So it's all about cash flow. And what I want to show you is how to use the power of life insurance to create cash flow for life and generational wealth for your family or your heirs that can live on forever. How you can finance your retirement. And it's the secret wealth strategy that's hidden in plain sight. So the earlier you can start, the better. But just understand it's not too late. You start where you are. I'm going to show you examples of people age 50 on up to in their 70s. Okay? So the earlier you can start, the better. But it doesn't matter as long as you start and you learn how to create cash flow. Okay? Now you might be looking, you say, well, why life insurance? Life insurance, I've heard that's a bad investment. It's not an investment. So let me talk to you about why you can use life insurance. So at passive income time, retirement time, would you rather have $5 million that's taxable or $3 million that's tax-free? Now, if I took the taxable and tax-free off, you might say, oh, definitely I want the $5 million, right? But when you look at it that way, from taxable to tax-free, it does make a huge difference. So let's take a look at that. If you had $5 million, the 4% rule says that you could take $200,000 without the fear of running out of money, okay? Now, let's assume this person's in a 25% tax bracket. They are retired now, and that would leave them with about $150,000 net income, what they could spend after taxes and without fear of running out of money, according to traditional financial planning, the Monte Carlo simulations and all of that, okay? This is in an account with little control, and it has uncertain taxes and multitudes of risk, okay? On the other hand, if this $3 million was in a cash value specifically designed whole life insurance policy that's paying dividends. Now, I have to clarify that there's different types, many types of policies. What I'm talking about here is specifically designed whole life insurance that pays dividends. Now, dividends are not guaranteed, but they are. Most of the companies out there, or at least the companies I deal with, have been paying a consistent dividend every year for over 100 years. So back to the example, we've got $3 million, and in this example, we could take $180,000 completely tax-free, zero taxes, no income taxes. not reportable to the IRS, because we would take it in the form of a loan. Loans are tax exempt. Now, there's other ways to take the money as well. We could use it as a distribution, or we could use it to supplement retirement income from another source. So in this example, we're all in with life insurance. In this example, we're all in with our qualified plan or mutual fund, whatever it might be that would be taxable. Okay, so this person would net $180,000 versus this one with $150,000. There's more to the example, and that would include Social Security income that would be taxable over here with most traditional accounts, and over here it would not be taxable. So that alone could be worth up to $250,000 to the average family during retirement. Just during retirement, $250,000 that would be lost to unnecessary taxes. So if this was your pie and you've worked your entire life to enjoy the fruits of your labor, how much of that pie do you want to share with the IRS? When I ask that question, most people tell me as little as possible or none, but they don't always really think that through. So there would have to be some changes made if your money is now in a qualified plan. But in this example, that's a 25% share, which is about average for most people to pay in taxes on their retirement plans. Here's a quote from Ed Slott. He's an IRA and tax expert. He's a CPA. He says the tax exemption for life insurance is the single biggest benefit in the tax code. That's a profound statement. The single biggest benefit in the tax code is life insurance. Life insurance is the best financial tool ever, if you ask me. I happen to be an agent, so I am biased, but I do own several life insurance policies, contracts that I own and control. So I've seen it work myself. I've used it myself over the last 15 years, and I'm excited about how it's going to work for me during retirement. You see, life insurance provides multiple uses for your dollars. In this illustration is a Swiss Army knife, and that's because you can use life insurance for multiple reasons. When we talk about retirement, there's basically three types of accounts, okay? So there's the tax now accounts, and excuse me, we're just using buckets here to illustrate the point, but taxable now, these accounts would be things like CDs, stocks, some bonds, mutual funds, real estate, where every year you will either have to, fill out a K-1, or you're going to have a 1099 or some type of tattletale form for the IRS, okay? But you can pay them now or you can pay them later. So tax now is not necessarily a bad strategy, depending on what you think taxes are going to do in the future. And of course, taxes are uncertain. So a tax later bucket would be things like IRAs, 401ks, right? Over here in a never tax bucket, that would be, a Roth IRA possibly, some bonds, but again, bonds are relative, and it would be permanent life insurance depending on how it's set up. Permanent life insurance allows the owner to remain in control and have access to the capital. And you could use this insurance at any time for any reason. There's no Mickey Mouse paperwork, as my mentor Nelson Nash used to say, and there's no bank qualifying to make a loan. And the dividends in the policy, the permanent life insurance, grow on a tax-deferred basis. They can be accessed at any time tax-free as long as a few simple rules are followed. Death benefits from a permanent life insurance policy are income tax-free to the beneficiaries, and of course that's subject to the size of the estate. Currently, I think it's about $12 million. Back to distribution income. I showed you an example earlier of $5 million and $3 million. But in this example, we're going to use a nice round $1 million. So if we took, again, the 4% rule, that's about $40,000 that we could take out of the account without fear of running out of money, according to traditional financial planning. Now, this money would be taxable. So after taxes, assuming around about 25%, that person would net $30,000. Now, how does that sound to you? You've got $1 million saved and you net $30,000. Now, of course, you might have Social Security income, but that income would be subject to tax. In this example, if somebody had $30,000 of net income or $40,000 of gross income, then that Social Security would be taxed. And for an average family, a husband and wife, spouse, that would be about $250,000, $250,000 over their lifetime. Let's look at another bucket. People say, well, hey, my income is taxed a little differently. I've got real estate, I've got bonds, I've got things that maybe are tax advantaged. I've got a pension, I've got some other type of asset that's providing income. Okay, so in this example, again, you've got $1 million, and according to, again, traditional financial planning, the 4% rule, that would still allow you to take out about $40,000. Now, this income, again, is taxable. It's going to be taxed differently than this. So let's just say, 50% of it was taxed. And so now this person has $35,000 of net income. So a little more, but their Social Security income is still subject to taxes. So whatever that might be, but again, it could be up to $250,000 of unnecessary taxes. Now over here, we've got the never tax bucket. So again, this could be a Roth plan. It could be a number of sources. But I'm going to call this bucket, the never tax bucket, permanent life insurance. All right. So in this example, same one I showed you earlier, basically, we've got $1 million and we could take about a 6% safe withdrawal without fear of running out of money. Now, this all depends on where you start in life. And again, we were using a person age 55. So they should be able to take about $60,000 of income alone from this policy. So again, it's tax exempt income because it's cash flow. It's considered a loan. It is a loan. And but in this example, we're not going to pay the loan back. Okay, it would just come out of the death benefit when this person should pass. Okay. The biggest benefit here, though, that I want you to notice is that $250,000, whatever the amount is, in Social Security income would not be taxed because this loan does not show up on a tax return. As a matter of fact, if this is the only income that a person had, they would not even have to file an income tax return. So you might want to check with your CPA or your advisor with that issue, but relatively speaking, they wouldn't have any income from assets reportable to the IRS. So how does that sound? Which bucket would you like to have when it comes to distribution time retirement? So again, we're taking loans for cash flow. And since most people talk about retirement, they're looking forward to income. That's really what you have. So here's the general rules for that. It doesn't have to be complicated, and these numbers aren't exact. I'm trying to use round numbers to simplify things. It really all depends on how you treat the policy. See, we've been taught to put as little as possible into life insurance, right? Well, have you ever heard, if you were looking at it as a bank or a place to accumulate money, have you ever heard about somebody having too much money? Okay, having too much money in the bank, an account that you own and control. Okay, so it's all in how you treat that, how much you put in, how much you contribute. All right, so you could move, if you have these other assets at retirement time, into accounts that are tax-free, into the tax-free bucket, because now, after age 59 and a half today, these accounts are ready to distribute. So if you had a qualified plan, an IRA, a 401k, a SEP, whatever that plan was, you could move the money without fear of getting a penalty, a tax penalty, at least today. Now, the account would still be subject to tax, of course. So again, you could pay the taxes now, or you could pay the taxes later. But I can help with that. That's what I do, is show you ways to move this money so they're not subject to penalty or unnecessary taxes. The longer that you let your money grow, the better. So if you can capitalize with 10 years of premiums, contributions, as a starting point, and of course the longer the better, we like to show 10 years plus, so 15, 20, 30 years is better, obviously. And these policies can be backfilled, so maybe you had a lump sum from a distribution, and then maybe you were expecting a windfall later on, maybe from an inheritance or the sale of another asset. Maybe it's the sale or distribution of your retirement account, whatever that might be. But again, the longer you can capitalize this account and your money can grow, the better and the more cash flow you can receive. All right, so the tax benefits. These benefits are not a loophole. You hear so many people talking about a tax loophole, but that's not the nature of whole life insurance. Life insurance existed well before the creation of the current federal income tax, which was created in 1913. And by borrowing against the policyholder faces no income tax liability. It's a loan. A policy loan does not constitute income in an accounting sense and is not subject to income tax. Let's look at some examples. And these are real life examples. These are clients of mine. Their names aren't here, but I've got many, many examples. So what I want to show you is a few different examples at different ages. Now, this particular client started at age 50. We chose a paid up at 65 policies. Now, there's many ways to build policies, and that's a whole nother conversation. They contributed $60,000. Now, hopefully you can see this okay. I'll try to zoom in, but they put in $60,000 for 15 years. And then you see here that no more premiums are due. This policy is contractually paid up. Now, you might have multiple policies with multiple goals. This particular client did. They wanted protection from disability and long-term care and premature death. This particular policy provided all of that. The income at retirement time is adjustable, can go up or down just depending on your situation. The loans would not be repaid in this example. You could repay the loans. The kids could pay the interest portion, perhaps. They could pay the entire loan. It might be to their benefit. They could look at it as another way to create wealth themselves. But in this example, we're not looking at repaying the loans, okay? So what we did here, though, if you look here, it says 5-year delay. So at that point, at age 65, the net cash value of this policy was $936,996. The death benefit at that time is $1.8 million. So what we're doing is we're taking loans against the death benefit. So if we took a $100,000 loan and you had a $1.8 million death benefit and you died, your heirs, your beneficiaries would get $1.7 million, right? Because you had taken the $100,000 loan. So in this example, we waited 5 years. So if you notice, this money continued to grow from 936 to 981 to $1 million. And at age 70, it's $1.1 million. The death benefit had grown to over $2 million at that time. So now we want to take income. Now we put in $60,000 a year for 15 years. And what we're going to do is we're going to take $80,000 a year out through retirement. So we're spending the death benefit with tax-exempt loans, okay? So at that time, we're out here at age 90. I don't know when this person's going to die. None of us know, but we're just going to take it at that point, okay? So at that point, we have taken 20 years of income, right? And our death benefit has gone down because of the loans, but our cash value has gone down because of the loans, okay? This person had taken out $1.6 million, 20 years times $80,000, okay? So at that time, I want you to notice that they had put in $900,000, $60,000 for 15 years, $900,000, and you see down here, okay, that their cumulative net outlay was $700,000. Okay, $700,000 more than they had initially put in. So you can see these numbers changing here. 900, 820, they took out 80, 820, and then it goes down by 80,000 every year. Okay, and if they died at age 90, their family would still receive $743,000. So they took out $700,000 more than they put in, and they left their family $743,000 for a net gain of $1.43 million. How's that sound? Let's look at another example. This is a totally different type of policy. This policy is a traditional policy that's paid up at age 100. This policy is in force. The policy was issued at age 53. They put a base premium of $30,000 into the policy, and we put a PUA rider on the policy, paid up additional insurance. Again, that's another conversation. Put in $70,000 a year into the policy. This person was an optometrist, a doctor, and they wanted to borrow from the policy in the future, which they have done now, to build a new home. And they wanted to finance their retirement, and similar to the example that I just showed you. Now, what I want you to notice here is that in year 3, age 53, and the reason it's cut off because this is a real life example where we took an in-force ledger. They had taken a loan at this point, and their death benefit was now right at $1.5 million, okay? So the policy, they're putting in the $70,000 on up to age 60, and then they were going to decrease the amount. All that's really due for the premium is $30,000, so they're going to decrease that back down. Now you might be asking yourself, why would they put more money in? Well, you'll have to watch some of my other videos to understand that. This particular client wanted to reduce that at retirement. So here we are at retirement, age 68, I believe, in this example. And what we're going to do is take out $72,000 for 25 years. So we do that. Over here, again, there's a loan against the policy. The cash value is going down. The death benefit is going down. This is the net death benefit, okay? At the end of that time, age 90 again, so it's 40 years into the policy, and if they died at that point, the net death benefit would be over $1 million to their family. They still would have some cash value in there if they kept living. And they do have a loan, so that loan is from the gross death benefit, and that is the net death benefit. So they had received $1.8 million in cash flow. $907,000 was what they had put in. All right, so if you added up all of their premiums that they paid, they put in 907. They took out 1.8 million, so that left them with a net gain of $892,000, along with $1 million death benefit. Here's another example. So in this example, $200,000 a year, age 55 going to 65 for 10 years, right? So at that point, they had put in $2 million. Their cash value is $2.1 million. No more premiums are due. The cash value continues to grow, as you see here, from 2.1. If they never touched it, it would grow to $5.2 million. Okay? At age 87, the death benefit would grow to $6.2 million. The longer these policies are in force, the better they get. This is the same contract, and at age 58, they did not, that was just recently, they didn't want to put the money in 1 year, okay? So they didn't put any money in. They were planning on putting it in the next year, and they were loaning to pay the premium. We can always, what we call backfill, put the money back. The loan doesn't have to be repaid. You can pay just interest. Lots of examples, lots of flexibility. I just want to demonstrate to you the income from this policy and what it could provide you. So in this example, we showed them taking $120,000. Again, you could take more, you could take less. It really just depends on the person and how long you want the money to last. All right. Again, if you take too much, you might run out of money. So they're tax-free loans. There's no repayment. It reduced their tax liability. They're in complete control of their money. In this example, if they had kept the money in the IRA and it was getting 8%, we're just assuming that, it would have grown to $64,000. The 401k, had it been getting 8% net of fees every year, it would have grown to 1.3. So that would have given them a total of $1.4 million. Now, this goes back to the examples I showed you earlier, but with the 4% rule, that would give them about $57,000 a year, and that would be taxable. So compare that to the $120,000 cash flow tax exempt. Which would you rather have? So again, these are just examples, but they are real life examples. In this example, this is a policy that's been in force for many years. The client is age 68. They were a referral to me, and this policy has been around a while. As you can see, it was a policy that wasn't funded heavily. It was issued at age 50, and they're now age 68. So they didn't put in a whole lot, and they didn't have any loans at this point. Okay, so what we did is we took a loan on this policy to pay property taxes and teach them about using the policy for cash flow. And he's repaying the loan on a monthly draft, and we applied for more. So here's the policy that we put in force. Now, originally, if you notice on this policy, that this client was rated, all right? So they did have some issues with their health, and originally they were declined. But because I'm an independent agent, we were able to apply with different carriers, and we ended up getting them a select preferred rating. So in this case, they wanted to really heavily fund this policy. They wanted to use it not only for banking purposes while they were working, but they wanted to use it later, possibly for retirement income or supplement their income. Again, this person is a veterinarian. They have substantial income and assets already. So we were putting in $24,000 base premium and then another $48,000 into a PUA rider and a long-term care rider on this policy. So again, you might be asking, why would you put in more than the base premium? Well, again, you'll have to watch my other videos or sit down with me to learn why that might be important. So for a total of $72,000 annually, this person was putting in. So their goal was to have protection from long-term care. They didn't want to wind up in a nursing home or putting a burden on their family, and they wanted to be protected. They wanted their family to be protected in the case of premature death. We haven't really talked about income and how they will actually use it in this case. Again, this was more of an access to capital example with more protection for things like long-term care and death. So this is what the policy looks like. This person's still working in their business. They just celebrated their 50th wedding anniversary. They've taken one policy loan of $20,000. They're paying it back. They still have a term rider on this policy that is convertible without evidence of insurability. So if their health has declined further, they still get that preferred rating that we discussed earlier. I believe it was a select preferred with this particular carrier. So they're 75 now. The net cash value on the policy is $128,697,000. This is the actual illustration from February of 2020, okay? And you can see that they had a base premium, and then they had what's called ALIR, a PUA rider on the policy, okay? They've taken the $20,000 loan at a 5% current loan rate, and the loan rate will be due, or the loan interest will be due every year on the loan. All right. So the policy is continuing to grow. They're continuing to fund it, and they will fund this policy, later in life, but they can reduce the premiums at any time. Here's one more example I wanted to show you. This person was age 69 when they took out the policy. So it's never, well, I shouldn't say never, but just because you're later in life doesn't mean it's too late to start one of these things, okay? So this particular person was already retired. They were a United States Air Force veteran. They were a real estate investor. They still do have a sizable real estate portfolio. They had always followed traditional planning, and they prepaid their mortgages. They had put together a complicated trust for their children, and they came to me looking for a solution, another way. And what they decided to do was to fund a 10-pay policy, meaning it's contractually paid up in 10 years. They wanted to put in $27,000 a year, though. So that's what they did, $27,181. They paid monthly, okay? And the policy started paying dividends from year one. Here they are today. They're age 82. The policy has been paid up, as you see, since year 10. They have an annual dividend now of nearly $16,000. It was $15,942 at that time, but as you see, the dividend continues to grow because the policy continues to grow. All right. The total cash value was $341,458. This is the actual contract. This is the in-force illustration. And the death benefit started at $250. It's now $417,000 at this point. All right. So they started at age 69. They're 82. They had used traditional planning. So let's look at it, what it looks like today. Policy is paid up. They put in $271, and their cash value $321. See it right there? Their death benefit $392. It's paying a dividend of $11,843. So those are some examples. I just wanted to show you these things. This policy, as you see, was put in force in 2007. So it's been around a little while, about 13 years or more when this illustration, or now, than when I ran this illustration. So those are some examples of people starting after age 50 using this income strategy for retirement. So I want to thank you for your time. If you have any questions or comments, just leave them in the comments section below. Thank you for viewing Legacy Money, and I'll talk to you next time.